Good day, everyone. My name is Atenko Simchebeza, Equity Analyst at PSG Wealth team. Today, I'll be discussing our latest EIA report completed on Old Mutual. At the beginning of last month, Old Mutual released its first half results. My overall conclusion is that Old Mutual is showing signs of recovery, and in this session, we'll unpack the results and touch on the valuation. Old Mutual showed the signs of recovery with the pleasing performance from the Mass and Foundation cluster. However, weakness in the other division offset some of that performance. The pandemic is still weighing on life assurance counters, excess mortality coming through and additional provisions being raised. This, coupled with the weak macro environment, explains why some of the key performance indicators are still below pre-pandemic levels. Balance sheet is still strong, with a solvency ratio of 177%, which is in line with the targeted ratio. At 0.77 times, price to group equity value is at a discount to peers and still below pre-pandemic levels. But we stress improving profitability will be the key in a positive re-rating. Value the company on a sum of the parts valuation, and we see significant upside and maintain our overweight recommendation. The unbundling of Nedbank shares is still on track for the fourth quarter of 2021. For every 100 Old Mutual shares held, investor will receive 1.32 Nedbank shares. Currently, Old Mutual still owns a 19.4% stake in Nedbank and is looking to unbundle the 12.2% stake. The remaining will be hedged with a zero-cost collar as it's still under strategic review. Ex-date will be on the 3rd of November and the transaction will be effective on the 10th of November at market open. We think this is largely reflected on the share price given the jump on the day of the announcement, which is at the 25th of June. We think there's a high likelihood that Old Mutual share price will decrease around 10 to 13% on the ex-date. And once the transaction is effective, there might be increasing trading activity on the Nedbank side of things, as some investors might dispose of those proceeds. APE sales were up 13%, RFO was up 42%, adjusted for the direct COVID impact it was up 8%, adjusted headline earnings per share was up 70%, group equity value was up 4%, and in this period, management reinstated dividends at 25 cents per share. Looking at the impact. Since our overweight recommendations at March 2020, which was at the height of the pandemic, we've seen a positive re-rating as reflected in the price to group equity value. Currently, it's at 0.77 times, which is a slight premium to historical average, but still below pre-pandemic levels. From these levels, we still see room for further positive re-rating. However, management strategy or management's drive towards improving profitability, as communicated in the recent Capital Markets Day, will be key to a positive re-rating. Looking at the total return performance. Since our over-recommendation in March 2020, the share price has risen by 57.5%. The life insurance index has risen by 12.1%. and the benchmark has increased by 73.1%. The whole sector has underperformed the benchmark, including Old Mutual, although it's outperformed most of its peers. Looking at performance relative to the index on a one-year basis, we see positive alpha of 34.2%, and on a year-to-date basis, we see positive alpha of 19.7%. Looking at the results a little bit deeper, we saw a recovery in all of the key KPIs, but most of them still below pre-pandemic levels. APE sales were up, results from operations was up, and also VNP margins were up. This came in ahead of consensus, and the beat was driven by the Mass and Foundation cluster, Within the mass and foundation cluster, there was an increase in productivity levels within the advisor sales force. Quickly looking at the other clusters. Personal finance and wealth was flat year on year. The corporate cluster, which is slightly smaller in the mix, was down year on year, and the investment cluster was significantly up year on year, mainly driven by the rebound in equity markets. Next, looking at the group equity value per share. Group equity value per share was up 4%. Both the covered and non-covered part of the business were up, but the real standout was the non-covered part of the business, which was up 24%, driven by equity markets. But weighing in on the group equity value per share was the PLC stake, which Old Mutual sold down in this period, which was down 29%. There was also the write-down of the Zimbabwean asset, which resulted to a more modest growth in the group equity value per share. Also, a key theme coming through was the excess mortality claims. They came in higher than expected at 3.3 billion. This weighed in on the results, and management offset some of the weakness by releasing provisions of 2.8 billion. Also in the period, management was forced to raise additional provisions, mainly related to COVID-19 future waves and vaccine hesitancy. So overall, though there's a recovery in the results, they're still below pre-pandemic levels within 2019. We value the company on the sum of the parts valuation, and as seen in Table 6, we still see significant upside. If you wish to place a trade, please speak to any of your financial advisor or contact our trading desk. Please also take note of the following disclaimer. Thank you very much.